Welcome in, folks. It's a buy one, get three bald in this one. Get three free in this one here today, folks. 4 videos up here for me to react to here today. We're talking Sofi Stock at the beginning of this video. We're going to hear from Anthony Noto speak about Sofi Stock. Obviously, Sofi had a very tough day today. It was down over 10 percentage points. I bought $13,000 of the stock at $7.06 here today. Then I'm going to go ahead and react to this one. The consumer overall is still healthy. That's out of Bank of America here. I want to react to that one. Then we'll react to this one of a few different folks talking about the consumer, where the market's headed, their opinions, things like that. I thought that would be an interesting one to react to. And then we're going to finish out this one with the SoFi CEO. He also went on Bloomberg about 7 hours ago. Want to go ahead and react to this one and hear what he has to say in regards to that. Appreciate everybody joining me as always. Thank you so much for being here, folks. Make sure you smash that like button and make sure you subscribe to the channel. 44,000 plus subscribers strong on the channel. Appreciate each and every one of you. 1000xstocks.com if you're looking to apply to join in there. The wait list is now probably 330 plus on the wait list for 1000xstocks.com. We're only letting in a few select people each week right now. And yeah, it's pretty awesome. Conference calls. We've got the compare feature on there, metrics, definitions, and we just keep adding stuff pretty much every single month right now, okay? All right, guys, let's get into this.
SoFi CEO Anthony Noto. Anthony, welcome back. Good to see you.
Good to see you as well.
So why is the stock down 9% despite a strong increase to guide? What is the street taking from this?
Okay, hold on. Listen. I hate that. I hate when, somebody expects the CEO to be like, why is your stock down? Like, they can't control what the stock price does in the short term. Like it's just insane. But a lot of times people will do that, and it's like so weird.
Yeah, I think it's important to focus on the results and what that means for the full year, and then what that remains for our 3-year outlook.
100%.
So in the quarter, we achieved 26% year-over-year growth in revenue, $581 million. We had 25% EBITDA margins. We grew that almost 100% at $144 million. More importantly, we have grown tangible book value per share 16% sequentially by about $600 million. We had record deposits of $3 billion and really strong overall performance. The most important thing about those trends that I'd point out, and the reason why 2024 is a transition year, is the growth was driven by low capital, high return businesses, our technology platform business, and our financial services businesses. Those two businesses, when combined, grew 54% year over year against lending that was flat. As we came into 2024, given the uncertainty in rates and the economy, as well as liquidity for the industry, not us, and despite having excess capital, we made the decision to put the resources behind these high return businesses that actually are big enough now to drive our overall growth and profitable enough to do that. And so that's the key message coming out of the quarter, is that transition is taking place and going incredibly well, which sets us up for a great 2024. We actually raised 24 revenue guidance by more than our beat. The comparison to Q2, we'd not provided Q2.
Hold on. Listen. This is so important regarding SoFi. So important, okay? So if Anthony Noto really wanted to pump the stock short term, okay, and have this stock go $15, $20, what SoFi could do is they could just give out as many loans as they possibly could right now. Who cares about credit scores? Who cares about this? Who cares about that? Just max out loans, right? And that might help the stock short term because it would look like revenues are going up substantially and members and things like that, right? But what happens when then they're on the hook for that if you get an unemployment-related recession, right? And then people can't pay back those loans because you gave a bunch of loans to maybe people that don't have the best credit and those sorts of things like that. So that's an important thing. When somebody wants to play it a little safe in the banking sector, I applaud that. I don't fear that overall.
Before, the street had an estimate there that was above what we guided to, but for the full year, estimates will be going up relative to consensus by more than our beat in Q1.
Nice.
Okay, so thanks for clarifying all the expectations game. What can you tell us about credit quality right now for borrowers?
Yeah, what we've said is that credit will normalize back to pre-COVID levels, and we're on track to do that. Our life of loan loss targets for our unsecured personal loans are 7 to 8%, and we remain comfortable with those expectations. We are higher in credit than most. We focus on prime credit. And we have very high FICO scores and good cash flow ratios when we underwrite credit, but we've taken a more conservative view on credit primarily because of the fact that it's not clear where rates will go. At one point last year in October, people were talking about higher for longer. Then by the end of the year, they were talking about 6 rate cuts, and now we're looking at 1 to 2 rate cuts. That type of volatility and uncertainty creates a backdrop that we think allows us to be more conservative in lending and much more aggressive in technology platform in our financial services business. A lot of people don't realize that in our financial services business, we have SoFi Money, SoFi Invest, SoFi Insurance, SoFi Credit Cards, and a few other high margin businesses. And now it's now profitable, which allows us to scale that acquisition. And that's what's driving our 44% growth in members to 8.1 million now and almost 12 million products.
Anthony, there's been some dissection of the eco data, the macro data last few days, specifically the saving rate going to the low 3s.
Good
and
question.
Some argue it's a sign of
this.
stress, that consumers are sort of living on the edge. Others argue this is all about the boomer generation spending every last penny of their nest egg. Do you have any idea what's going on?
Well, we definitely have a member base that's saving. Our deposits grew a record $3 billion in the quarter. We provide a very attractive interest rate of 4.6% on your savings with direct deposit or with a large recurring deposit on a monthly basis. So we're seeing great trends there. And it's not just the growth in deposits, it's also the growth in spending. We had about $1.8 billion of debit spending on the platform, up from the low $1 billion last quarter. So we're annualizing about $8 billion now. And again, that's on a member base in SoFi Money that's at 3.5 million.
Guys, this is very important to understand this about SoFi. Okay, extremely important to understand this, the point I'm about to make here. You think about SoFi's customer base, and who do you think about? Your mental image should go to people under the age of 40, okay? That doesn't mean people aren't SoFi's customers who are 45 or 50 or 60 or 70 years old. But if you think about SoFi's customer base, you should get a mental picture of people ultimately between the age of 18 and like 35. That should be the mental image you get, right? Those age brackets are in wealth building phase, right? They are usually lower income, relatively speaking, right? Although SoFi usually has, a lot of folks that have higher incomes and have better credit scores. But just generally speaking, like if younger people are going to usually make less money, they're going to have less net worth, but they're in wealth building phase. They're also in a phase of their life where once you get in your 20s and your 30s, you're much more likely to start buying cars or buying homes or those sorts of things, or getting your first credit cards and building your credit up and all those sorts of things, right? And so it's very important to understand, like, SoFi is attracting the type of customers at the stage you'd really want to be attracting them, right? If you're a big traditional bank, your customer base might be a lot of people that are 50, 60, 70, 80 years old. And those people have already done most of their work in their life. They've already taken out most of the loans they want to take out, but they got big net worths, relatively speaking, right? They have, substantial amounts of assets with your financial institution, and that's good, right? But the issue is you've got to always be attracting the next generation and the next generation and the next generation if you want to stay on top of the game, because eventually people aren't here forever, right? And their money's not here forever. And then their money, when you pass on, it could go to philanthropy, it could go to charitable causes. For most people, it goes to their kids and grandkids, right? Well, if their kids and grandkids, let's say somebody has $1 million net worth, right? And now their trust all done, and that money's passed down to their kids and grandkids. Well, the problem is if their kids and grandkids are not with your financial institution, they're with a SoFi, let's say, for instance, well, then that money then goes to SoFi at that point in time, right? And so these are just important things to factor in here in regards to when you attract the younger generation to a product like a SoFi. It's a huge 10, 20, 30-year benefit. It's not like you benefit for a year. You're benefiting for the next decades, the next generation, right? Now, I want to show you something here, okay? If I think about the 3 stocks I have that are kind of financially related, there's 3 of them. There's SoFi, right? Obviously, the one we're talking about right now, kind of they're more of a new age bank, I call them. You have PayPal, which is just a traditional fintech, right, with PayPal, Venmo, and Braintree. And then Shopify, which Shopify has Shopify Pay, and they help run a lot of transactions for businesses overall. Now, the important thing to understand about these 3 businesses, right, is when it comes to Shopify and SoFi specifically, those are companies that are at they're at first inning of profitability. Okay, so these sorts of companies trade at very high forward Ps because they're at the first inning of profitability. And if you think about where SoFi's profitability is 5 years from now, 10 years from now. If you think about where Shopify's profitability is 5, 10 years from now, it's like a night and day difference than where they're at, right? PayPal's been very profitable for quite some time now, so they're not going to, but obviously PayPal should command more than a 12 forward P on this stock, right? It should command somewhere between, I think, a 20 and a 25 would be pretty fair for PayPal. So the important thing to understand is actually all three of these in the end are going to, in my opinion, have proved to be all undervalued. All of them. All of them will have shown that they're undervalued, and I think people will look back 5 years from now and be like, oh yeah, PayPal back in those years when I was trading out of forward P at 12, it was very undervalued. But then they're also going to look at these and be like, dang, it was actually undervalued with these because they'll eat up profitability over this next 5 years, okay? So just a little food for thought. And I love this comparison feature on 1000X. It is my favorite feature other than the conference calls, just being able to type in a ticker symbol and listen to conference calls right now. That's phenomenal, man. But overall, just very, very helpful. All right, next one up here. Let's get into this one. The consumer overall is still healthy.
A policy meeting tomorrow, and while a rate cut is not expected, Wall Street will be closely watching the language from Chair Powell on Wednesday. So how should you be positioning around the Fed? Joining us now is Oh-Sung Kwon from Bank of America. Good to have you back.
Thanks for having me.
So you like dividend-paying stocks, but here, trying to think like a lot of investors out there, if we're higher for longer, right, and you can get yield from other places, and equities in general are richly valued, doesn't that kind of work against the dividend payer idea?
So what's really interesting is that if you look at the 100-year history of the S&P 500, 1/3 of total returns came from dividends. But if you only look at the past 10 years, dividends only represent about 15% of total returns, so only half of what we saw over the past 100 years. And that's basically because rates were zero. Even if you collected dividends, what are you going to do with them? You were facing huge reinvestment risk. But when rates are at 5%, cash is king. Investors want dividends today than tomorrow. So I think dividend-yielding stocks are going to do better, especially in a higher for longer environment when bonds are not that attractive when rates could potentially go higher. But dividend-yielding stocks that benefit from higher inflation as well, those can potentially do better.
I guess also a big growth story of the past 30 years has been these tech stocks that, until last week, many of which were not paying a dividend. I'm being joking a little there.
Meta started all
doing what it's doing. But earlier we were talking.
By the way, that just made me so happy. Because I just remembered I'm going to be getting another massive dividend in a couple months. And then another one. Because I got that huge position in the public account in Meta, right? I have a position in the Patreon portfolio with Meta too, but the huge positions in the public account available in the private stock group, right? And I'm just like, that's so sick that every 3 months I'm going to get that huge dividend payout. Like I just look forward to that now because I'm like, it's a bunch of extra money I'm going to be able to invest every 3 months. It's so sweet, man.
Santoli about the consumer and how some pessimism around the consumer.
And then the other best part of that is, Meta's going to up that dividend pretty much year in and year out. So what I'm getting this year is going to be a much smaller amount than what I'll get, let's say, next year and the year after and the year after. That's
has
awesome,
some
man.
stocks linked to
Love
that underperforming. You seem pretty optimistic still. Is that because you think the consumer could perform better through the year than many others are counting on?
Yeah, I think both the consumer as well as the industrial side of the economy are probably going to do better. When it comes to the consumer, we haven't really seen that much impact from the rate hiking cycle so far. And I think one of the biggest reasons is because A, 90% of mortgages are long-term fixed, but B, because of the wealth effect. The U.S. consumer has 5.5 times nominal GDP worth of net worth, $150 trillion. So you got to look at the whole balance sheet, and those who have a lot of cash on the balance sheet, they're actually generating higher interest income. So for those high net worth individuals, they're actually benefiting from this higher interest environment. So I think the consumer overall is still healthy. And
yes, but let me push back against that. Okay, here's the issue, big issue. How many people are we really talking about as a percentage of the overall economy are really benefiting from interest income? It's maybe the top 10 or 15% of the wealthiest people, right? The problem is to have a great economy and have great earnings, you need ultimately at least 50% plus of people doing very well overall, right? Who do you think's buying all the iPhones and clicking on all the Meta ads and Instagram ads and everything else, right? And buying all things off Amazon. So at the end of the day, you can't just count on the very wealthiest people to add to your economy overall, because they're only going to spend so much. And then that's about it, right? And so you really got to count on the middle class being in a good place too. To have a truly great economy, you've got to have the middle class feeling great as well. And they don't right now. They might change in a year, 2 years, 3 years from now. But right now, the truth is the middle class does not feel great. Okay. So yeah, I think that's worth noting.
Actually, if we stay at this full employment environment, then I think the consumer is going to stay healthy.
Particularly the higher end consumer, to your point, especially if we start to see some bifurcation there in a more meaningful way. I want to go back to this notion. I'm looking at your report. AI CapEx means money out of tech, money into non-tech. We're seeing this to a certain extent through earnings season already, that the non-AI application companies, more of the infrastructure companies, do seem to be doing well. Just today, Seema Modi reporting on some of the industrial companies that are really benefiting from the AI infrastructure build out. How do you position yourself as an investor to see those returns, realize those returns above and beyond the mega cap tech names?
Yeah, so there's a very interesting dynamics that we are seeing in the market today. Is the reversal of what we saw between tech and non-tech. Tech companies cut costs last year. They lowered their capex as well, down by about 4% last year. This year, they're increasing capex by about close to 30%. They're done laying off people. Layoffs in tech sector is actually down about 65% year over year. On the other hand, the non-tech sector, they're maintaining their capex this year. Last year, they increased their capex by about 9%. Their layoffs are still very elevated. It's actually up 1%. So it really feels like tech is done cutting costs. They're investing in capex. Non-tech sector is still cutting costs. And they're actually going to be the beneficiaries of AI capex, because last time I was here, we talked about how power is now the biggest constraints in building data centers. So these power plays, industrials, materials, commodities, I think they are much better positioned than the tech sector.
So I am going to ask, do you think markets are de-risked here going into the FOMC meeting this
week? So the pushback against that there is, okay, you're bullish on commodities, you think they're going to do well. Okay, that's a problem for the consumer. That's a problem for the middle class. It's a problem for inflation. That's a problem for rates higher for longer, right? That's a problem for CPI and all the other metrics. So,
The fact that we've seen such a dramatic shift in terms of what the market's pricing in terms of rate cuts, I think it's like 30% or 35% before 35 basis points before the end of the year now, maybe not even as soon as summer.
Yeah, I think for this FOMC in particular, I think the risk is skewed to the upside for equities, because the rates market has priced out 2 full rate cuts since the end of, since the last FOMC meeting. And especially if they start talking about potential taper of QT, which is our house view, then I think that's broadly positive for equities.
Yeah, I hope you guys enjoy me kind of pushing back against these points sometimes, because I love to push back against the bears and the bulls. I love to push back against some sides. And so, that's one of the things I love about having this channel is I can hear a bull say this and this and this, and then I say, well, here's the problem with what they said. And same thing with the bearish case. And so I hope you guys enjoy that. That's the main thing I enjoy out of this channel personally. The consumer is definitely slowing.
Of Goldman Sachs. The note that really raised my eyebrows, to be honest with you, this weekend was one from Adam Parker of Trivarium.
Adam Peter Parker.
Enough so that I was like, you got to come on tomorrow and talk about this, because this is a bit of a change that I want our viewers to know about. Adam joins us now. All right, so it's good to have you back.
Yeah, good to see you.
You have made a bit of a pivot, if I can call it that. And I'm going to read the headline that I took from your note, and we can discuss. Our recommendation had been that the bull case was far more probable than the bear case, driving our judgment that there was a material upside to the S&P 500. But now our view has changed. Okay, that got my attention. Why has it changed?
Well, the 3 pillars to the bull case were easy financial conditions, gross margins expanding, and a belief that earnings are going to grow. The 3 pushbacks we always worried about were kind of a tightening set of conditions, slowing consumer, and a China recovery that's pumped. So we try to market our views. And I think what I wrote there is, look, I have no idea now if the next 10% moves up or down. It seems to me like 5,600 is about as likely as 4,600. So I think the way Jim framed it makes sense to me, kind of 50-50 chance we move in either direction. Why? One, the stagflation like I wrote in my note, if stagflation were a stock, it would be up, right? The economy looked a little slower. We could get some cyclical pressure on inflation a little bit. Two, the consumer is definitely slowing, and you can see that through some of the corporate earnings and macro variables. And then third, we scoured every word of every earnings call transcript year to date for any mention of China growth, China demand, China initiatives, and it really hasn't picked up. And if I look at stuff like in the healthcare tools or others, I'm just not seeing any evidence of that. And I know a lot of investors I talk to, probably the same crowd or a lot of the same crowd that that Tony at Goldman talks to. I'm not. People think China could get better, and if that's what they're expecting and it doesn't, there could be disappointment. So I think the risk reward is more balanced. I guess that's my summary, Scott.
But superseding, most of that, it's not like all that much has changed. Now, maybe the stagflation word coming into the lexicon of late is a difference. But you have been telling me that one of the reasons you've been more bullish than most is because of margins.
Yeah.
And that was the greatest takeaway, that margins were going to stay strong, and that was going to be able to carry equities higher, therefore justifying the multiple where we're currently trading. Are you suggestive that could be changing as well?
So there's three reasons to believe margins. One are structural reasons. I think those are still in place. Two are AI. That's still going to happen. But the cyclical stuff like input costs from commodities, materials, that part may be a little bit different. I put in the note just a basic commodity index. We're up kind of 8-9% off lows. And so there may be a little bit less of a tailwind or, than maybe thought. So I could see somebody tweaking their cyclical assumptions on margins, particularly if inflation has a bit of an upturn. I mean, the correlation between forecasted margins and CPI is pretty high for all but the mega cap companies. So yeah, mark to market, I feel a little bit less good about cyclical benefits to gross margins in a 6-month view.
You also say that at some point we're likely to have a 15% or more sell-off in the S&P. Admittedly, though, you say we're not there yet. What gets us to that point? Is it? Well, I'll let you answer. What gets us to that point?
I was just kind of saying, look, like if stagflation were a stock, like it's in the lexicon, as you just said, it's up off lows. If that starts being more in the everyday vernacular, that's an ugly word. Right. Is there a chance that we get in this summer, the economy looks like it's slowing, but we're getting a cyclical uptick in inflation? Maybe. And that's what would cause a big sell. I don't think we're there yet. I think it's just something that if I assigned a 0 probability to 9 months ago, it's 20% or something. It's not 0. And I got to really watch that cocktail because that's a cocktail with a hangover.
So what you just described there, could I see a big sell-off in the summertime if certain things play out? So let's say, for instance, we have a situation where commodities keep running. Let's say oil price, next thing you know, at some point during the summer, June, July, is $100 plus. CPI is still coming in like mid 3s. There's even worries that maybe it's going to go high 3s. In this sort of environment, and let's say the economy, if anything, starts to, let's say earnings aren't quite as exciting for next quarter or guides are weak or something like that, could I see a big sell-off in that sort of situation? The answer is yes, I could. I could in that, because then if that happened, everybody would throw out any rate cuts this year. So then the discussion starts to completely move to 2025. And do they cut it all in 2025? And if so, when is that? And everybody starts making their predictions for 2025, and just no one would be confident that there'd be any cuts in 2024, right? But the worry is if simultaneously you started to see, let's say, unemployment start hitting like the 4s, not enough where the Fed's concerned, like the Fed's got to really see unemployment go to start to approach 5% or higher number. Let's say we're at like a 4.2 number over the summer, or 4.1 or 4.3. Meanwhile, you got inflation that's still an issue. Then people start to worry about, we might be going into a stagflationary type economy in 25. So if that were to all play out, which it's a lot to play out there, but if it were, could I see a big pullback in the market? Absolutely. If that were to happen, right? And that's a big if. We'll see. So far, earnings have been, it depends. For the companies that matter the most, earnings have been pretty respectable. For some of the companies that don't get talked about as much, some of those companies haven't had too exciting of numbers so far.
And some would say, no matter what, look at PCE, listen to the Fed. Just because they're pushing off or out doesn't mean they're pushing away. we still expect the next move from the Fed to be a cut, correct?
I think so. I like frameworks, and I like people who are disciplined, and I can understand the frameworks, and I can understand, how, deviations can cause change. I don't really know what their framework is, to be honest with you. And I know that the people who follow them carefully have not been successful at forecasting their movements.
Good point.
So I can't really impregnate that into my view of the equity market. I got to take a step back and say, what do I think causes volatility into the corporate earnings? What I think causes volatility in the multiples? And on the margin, I feel less good about it than I did at the beginning of the year. And I'm just trying to be intellectually honest, tracking stagflation, tracking the consumer, and tracking China. Those things look worse than they did a few months ago. There's no way I could keep intellectually honest about that. Underneath the hood, I think there are a ton of opportunities. I think dispersion's widening. I think there's, estimate achievability on margins will be a big issue. And so there's lots to do underneath the hood. But I think at the top market level, the risk reward's more balanced.
Well, on that note, I'll ask you one more question before I open it up to the group here. Under the hood, you also suggest that I guess we could say the engine of this market might be changing in terms of what you like best. Now, you were telling me and our viewers, you're a regular on Closing Bell. So you were suggesting, hey, buy energy. We like energy before a lot of other people liked energy. Now energy has had this run, and you had always been with me as well, saying you want to be overweight tech, right? Even in a marketplace where tech is such a sizable part, you want to be overweight that. That's changing too. You say, we recommend that investors who are overweight technology and energy begin to reduce their exposure and add healthcare, consumer staples, and utilities. Now, I don't need to be a rocket scientist to say, okay, he wants me to get out of tech and energy and get more defensive in healthcare, staples, and utilities.
Yeah, I mean, what that chart you're referencing is literally what is the historical stagflation playbook. If you start believing stagflation grows more, the two worst performing sectors were energy and tech, and the best three were healthcare, staples, and utilities. So if that starts gaining traction from here, that's where you're going to be light. When I look at our sector recommendations, we have 28% of the bet in tech with tons of AI semis and software that's accelerating and the Mag 7. You still have to have that if you're going to try to beat the S&P. Energy's 4% or no, plus or minus the S&P. So it's obviously you can own 7 times as much tech as energy. So I still like those sectors, but I think you have to start trimming a couple percent and adding to healthcare and utilities if you start believing stagflation grows. So it was more alerting people in advance about what the stagflation playbook would look like if it does start to gain incremental traction.
Adam, it's Joe. If you would, drill down on that a little bit further, specifically as it relates to semiconductors and the AI halo. What's your feeling there as you look forward over the next 6 months?
So May 22nd, that's the day you don't make any plans. That's when
Super Bowl.
NVIDIA.
Yeah, that's when NVIDIA reports.
I'll be live streaming on Twitch, baby.
The news is likely to be good, but everyone
also, by the way, I will be live streaming on Twitch tomorrow for Amazon earnings. I believe it's Amazon, AMD, Supermicro, and Starbucks after the bell. So I will be live streaming that
too. So obviously, if I knew when they were going to tell us they were close to meeting demand or 3 months away from meeting demand, I would expect some sell-off. But, that note we wrote a few months back, Joe, that I think you saw the NVIDIA God trade, I still think that's the case, right? Like, you're not God. You can't call the top and then the next trough and then right at the next peak. You still want exposure to AI semis. Most of the companies are hyper-focused on how to implement and deploy it. So I still like that part a lot, and I expect this will be an overweight recommendation for a long time. Most of the guys who trade semis and the old kind of mafia from the last 25 years I hang out with, they're trying to figure out if it's time to rotate into the industrial semis. You saw some slightly better comments from Texas Instruments. You saw a little bit of back and forth between maybe negotiation, I guess, between ASML and Taiwan Semi. Ultimately, I think compute's going to grow well, and you're going to want exposure as somebody managing money to that theme.
Adam, I appreciate your time very much.
Yeah,
interesting.
Good to see all of you. What a good panel. I like the whole crew today.
Thank you, man.
Work.
We'll see you soon.
All right,
That's Adam Parker, Trivariate, joining us.
All right, back to Anthony Noto, SoFi CEO.
Guidance was raised. You're feeling positive about the way in which you're steering the company. You say you're at an inflection point. But why the second quarter being below expectations? What can you add to what you're seeing right now?
We had a great first quarter, as we reported 26% year-over-year growth, and it's in line with the transformation that we talked about, which is our combined tech platform business and our financial services business would grow 50% or more. It grew 54% year-over-year, and that combined with flat revenue for lending, and that was part of the plan. And we have
Rivian's going too fast around the neighborhood. Slow your Rivian down. Get a
our second
Cybertruck.
consecutive quarter of GAAP positive EPS, in addition to growing our book value on a tangible basis per share by about 16% sequentially. We also guided the full year, as you mentioned, above not just our beat, but also above our prior guidance. So that's a positive overall outlook. We had not given Q2 guidance before. We typically give the full year and then the current quarter that we're in. So at the end of 24, we gave guidance for the full year and Q1, not Q2. The analysts are using their own estimates for that. And because we're taking a conservative view on lending will be down sequentially in Q2, while our tech platform revenue and our financial services revenue will continue to have strong year-over-year growth, but also strong sequential growth and continued profitability as well. So we feel really great about the business and the transformation we've made over the last 6 years.
Yeah.
The fact that we can grow revenue 26% on flat lending revenue is a real testament to the diversity of our business.
Hey, Darcy, but you can't feel great about the share reaction.
You know, any given day, it's hard to predict what's going to happen with the shares. But what I can say is the business is doing incredibly well. The strategy is working. We're really happy about the trend. We are taking a conservative view on lending, but that's prudent given how uncertain the environment is. If the environment becomes more stable, we'll be more aggressive on lending. But right now, there's no need to, and the environment remains as uncertain.
Okay, listen. Okay, if somebody is a long-term investor, they should not be disappointed at the share reaction. They should applaud the share reaction. Because if you're a long-term shareholder of SoFi, somebody that wants to hold this stock for the next 5, 10, 15 years, right? You're looking at SoFi's numbers and you're like, everything's improving with the business model. The profitability is improving, the revenues are improving, how many customers they have is improving, and all of them are actually improving quite dramatically, right? How many different people have signed up for the products, Galileo, everything across the board. Meanwhile, you get the share price to stay low, under $10, $7, right? You should applaud that. Like I woke up today seeing SoFi down 10%. I said, let me look at the numbers. I looked at the numbers and I said, let's freaking go, baby. And I bought $13,000 plus of the stock. And I'm probably going to be buying the stock again later this week. I'll probably be buying it the following week and following week. And so ultimately, I look out there at SoFi and I'm like, please stay at $7. Go to $6. I don't care. I'm not planning on trying to buy SoFi and then get out next week and get out next month and it went to 10, let me get out. It's at 9, let me get out. So I'm playing the long game here, right? And so just anybody that's a true long-term investor is who cares? It just gives me more time to accumulate more shares and build out a nicer position in the stock.
As it has for the last 6 months on rates.
Mr. Noto, good morning. It's Ed in San Francisco. A lot of the questions I got from our audience for you were about the capital you raised and your strategy going forward. There was convertible in 1Q. A lot of interest in that. I actually am not clear why, but the people want to know. So that's the question.
Yeah, I think people misunderstand the share count. First, we did two things in Q1. First, we issued a convertible note at 1.25% interest. That allowed us to redeem a preferred security that we were paying 12.5% interest on. So that is going to provide an interest savings for us. And we've already noticed all of the holders of that preferred instrument. And so that's being redeemed sooner than expected. We also bought back an existing convert that was trading well below its face value. And that was accretive to book value. And it was basically neutral on tangible book value per share. So there's some perception that it was dilutive. It's not dilutive on a tangible book value per share. I think there's just a misunderstanding on what the total ending share count will be in the future.
Here's the deal, okay? You think Anthony Noto, with all his experience, right? Former very well-respected person from Goldman Sachs, right? The big dog of the big dogs. Do you think he's just going to do things to do things or not make smart decisions? Whatever decision he makes is going to be a much more intelligent decision for SoFi for the long term, right? And we see that his decision making is clearly about the long term. Otherwise, once again, he would just be trying to give everybody who has a pulse a loan right now, right? And he's clearly not doing that. And so at the end of the day, to think like, oh, Anthony Noto's not going to make the right decision for shareholders, like I know better, it just doesn't make sense. Like I fully trust that he makes every decision that is in the best interest of SoFi overall.
My colleague at Bloomberg Intelligence, Herman Chan, has a very clear thesis for you guys. You have a brilliant app, strong user interface, one-stop shop, and you're targeting young professionals. That's what they think. But the story really is this higher interest rates for longer environment narrative. How does that thesis work in that rate environment, Anthony?
Yeah, well, first of all, your colleague said it very well, and so we should consider having them being one of our spokespeople. But what I'd say is higher for longer is going to create challenges for financial institutions. We are very well capitalized. We have a 17.1% risk-based capital ratio, so we have ample cushion in our capital ratio relative to where we have to operate.
If you want to know how many shares of SoFi that Anthony Noto owns, it looks like he owns at least 7 million shares of SoFi stock, from what I'm seeing. Yeah, it should be at least 7 million shares of SoFi. It's a lot of flipping flapjacking shares. So, yeah, it's not like he's a small shareholder in the company overall. By the way, I'm looking to, on 1000xstocks.com, I'm looking to add SEC filings hopefully next. So let's say, I wanted to see all the recent SEC filings for SoFi. Ultimately, what I'm trying to do next is like basically have something next to earning calls that says SEC filings and just type in like SoFi and boom, all their SEC filings come up there and all the Form 4Ks and 10Ks and 10Qs are all right there. And so I could just easily access. I'm like, that's going to save me so much time. It's insane. So, but anyways, yeah, it's not like Anthony Noto owns a small amount of shares in this stock.
From a regulatory standpoint, and we have
he was very financially incentivized for SoFi to become a $25 stock, $50 stock, $100 stock down the road.
Liquidity. That said, as we saw today, another regional bank was really challenged. We're also benefiting from really strong deposit growth. We had a record growth in deposits, $3 billion of new deposits, and 90% of our deposits are from direct deposit customers, which means we're their primary account, and it's very, very sticky.
It's big.
But higher for longer will put stress on other people's balance sheets if they're not hedging appropriately the way we do. We hedge our loans once we grant them, so we don't have that interest rate exposure. We can also match what we're giving as an APY to our SoFi Money members against the loans that we're offering and the rates that they have to maintain a very high NIM, and we've been able to do that consistently. In addition to that, we also have the tech platform business, which is not tied to interest rates. And then in the financial services business, we have the Invest platform that's growing very nicely, good AUM growth, good member growth, and another source of diversified revenue for us.
We're a technology show.
And you hear what he talks about, hedging of loans and those sorts of things. Like, those are the type of things, if you're a very sophisticated gentleman from Goldman Sachs, those are the type of things you learn and those are the type of things you do, right? Those are also the type of things that maybe could hurt revenue growth or profit growth in the short term, right? But ultimately, they're the best long-term decisions you can make. If you don't want to hedge your loan book, well, you can set yourself up for some problems if interest rates go certain ways that you don't want them to go.
The specifics of your technology, Anthony, but I want to bring our audience that macro flavor that you so brilliantly give, because why are you more cautious on the US economy? Why are you seeing 5% excess of unemployment? Why are you seeing these interest rate cuts that you've now basically halved in your expectations for 2024?
Yeah, our balance sheet has grown quite meaningfully. It's about a $30 billion balance sheet now. So as we came into 2024, we had a choice. Could we come up with our own expectations for 2024? Could we use consensus expectation? Let's just take a planning stance that's really conservative. And the planning stance that we took then was that there would only be 4 rate cuts. The market was factoring in 6 rate cuts at the time. We also took a planning stance on unemployment that would be more than 5%. The market was well below that. And we also took a stance on GDP contraction that was modest. Well, here we sit today, 3 months later, and the market's only factoring in 1 to 2 rate cuts. So I'm really thankful we took a conservative stance going into the year, and I'm really thankful we still have a conservative conservative stance. I couldn't feel better about the underlying trends of our strategy and execution of our business, but I don't think we're in an environment where anyone has a really strong, high conviction level on where rates will be. There's still a debate whether there'll be any rate cuts whatsoever. So we just can't put the business at risk, hoping that we can figure it out. So we're going to a conservative point of view.
I love that. Like, once again, me as a long-term investor, I hear stuff like that and I freaking eat it up. I love that. I love that that man wants to play more conservative. We're in a financial institution here. We don't want to, things to go not the way they expected to go, and next thing you know, you got a go under situation, right? And next thing you know, you're like an SVB or whatever, right? You don't want to have to count on the Fed doing certain things and that you're going to be able to predict inflation and where the Fed goes. And no. Okay. I respect that. I like that. I like guys like him. I like guys like Jamie Dimon. I like guys that are a little more conservative when you're running a financial institution. Like, is he running a tech company also? Yes. But when it comes to the financial institution side, be more conservative. Yeah, so what? It hurts your growth short term. Ultimately, it's a long-term benefit. That's what I like about SoFi. One of many things I like about them.
You're moving away from this kind of trademark student loans and refi business. Why?
Well, the strategy when I came in 2018 was to create a one-stop shop for all your financial services needs. There was no one providing all the products that you need for the big moments in your life and all the days in between. So we offer home loans, student loans, personal loans, in-school loans, checking and savings called SoFi Money, investing, insurance, small, medium business loan, lead generation, in addition to the tech platform business. So the strategy was always about building a one-stop shop for all your financial services needs. And that's actually resulted in a diversified business that allows us to make choices on what we grow versus what we take a conservative view on.
Love it. I love it. Got nothing more to add, okay? Appreciate y'all joining me as always. Thanks so much for being here. If you are looking to get the wait list, 1000X, we're at about 330 plus now at this point in time, about 330 people. We're letting in a few people a week on either monthly plans or yearly plans. You can check out 1000xstocks.com and join the wait list there. Other than that, pin comment down there today. I'll put my Instagram and my X. If you want to follow me, post a lot of stuff on X each day, and post a decent amount of Instagram stories as well on different subjects. So if you want to follow me, those will be the pin comment down there today. Much love and have a great day.